Every facet of your retirement plan was designed to take advantage of discoveries in basic financial economics that show us how to design more effective portfolios. In this segment, I'll discuss with you some of the most important concepts we use when constructing your portfolio, including the relationship between risk and reward, how risk is measured, small and value investing, and tracking error. Let's begin with risk. What you have to know about risk is there's a direct relationship between risk and reward. Investors are paid systematically for accepting higher risk. The higher the risk, the higher the potential reward. Market professionals measure risk in standard deviations, the variation around expected average returns. For example, if we expect an average of 10% return for large domestic company stocks with a standard deviation of 20%, then in an average year, we might also expect them to have an annual return of anywhere between 10 and minus 30. Obviously, the higher the standard deviation, the higher the risk. Investors don't like these fluctuations. We'd all prefer a certain outcome to an uncertain one, but it's unlikely that we can meet any reasonable financial goal without accepting some investment risk. Investing in small and value companies systematically offers the opportunity for higher returns. There's good economic reason for that. If you think about it, investor returns are the exact mirror image of the firm's cost of capital. Smaller companies and value companies, which are distressed, have higher costs of capital whether they're borrowing money from the bank, issuing bonds, or issuing stocks. Said another way, investors like big, healthy companies. They demand a higher return for investing in smaller, distressed companies. So, investors that tilt their portfolios from the center of the market to hold more small and value companies can expect higher returns over the long haul. Small and value premiums are persistent and generous. Over the long haul, our best guess is that the equity portfolio we've constructed for your pension plan should outperform the global market by about 2.5%. However, these premiums don't show up each and every year. They can be negative for extended periods, which introduces their own risk called tracking error. For instance, small and value underperformed growth in large companies through most of the 90s. Then it turned around and they overperformed. The risks are different from normal risks that we're used to, but not necessarily cumulatively higher. The chief problem that small and value stocks add to your portfolio is that they don't track the daily media market reports that you hear. This tracking error can be disconcerting to investors that don't understand the reasons for their account performance. Investors typically don't mind periods when their portfolios outperform all their neighbors, but they get really cranky when they appear to underperform. In our next segment, we'll discuss the expected returns and diversification.